Hi everyone, it's great to have you back. Once again, I'm Noah Moluabi. I'm welcoming you to this program, Money Series. It's getting to be very interesting discussion going on right around here. I got some feedback from the last video about the compounding, the power of compounding interest, and people were asking me why compound interest. I understand that in some environments, yes, the compound interest is not very common, and I'm going to talk a little bit about that down the line. But let me start from this discussion, from this question that somebody posted me and said, oh, I'm only 22. I'm only 22. What about it? My point is this, the people that asked that kind of a question didn't actually tell us their situation, their economic status at this point in time. Whether you just started work, working for your employer and you're doing great and earning all that money and you're living in Midtown, okay, and what you intend to happen later on in your life. So you could be 22, yeah, great time ahead of you, or you could be in that stage where you are going through what we call the retirement cost, the cost of retirement. You're afraid to retire, because you're beginning to see signs that things may not be as wonderful as they are. Well, like I said, there is no age you are or where you find yourself at the point you get this counsel or this advice that you cannot ask your financial advisor. Talk to your financial advisor. I'm sure they can help you. They can find a way to move things around, help you reorganize your spending, the way you do things, and then you should be on track for a wonderful retirement. The number one point is you should be interested in doing something, doing something about it. Like, before going back to the 22-year-olds, okay, let's talk about, I remember the example, I was talking to one man, he was scared, he's a truck driver, okay, and he's been waiting for his social security to kick in 3 years' time. But he's now, and then looking for additional means to buttress and push, add a little thing here and there for that kind of, for the kind of retirement that he has, kind of. Luckily, he's paid off he will be paying off his housing, so he has a house. Rent is not the issue, okay? But because for us in the US, where you live is a major issue, and we'll talk about more about that and when we talk about the compound interest and why it's such a big issue anyway. So for him, rent is not the issue, but he's afraid what will happen, whether he can even make it to those 3 years, through those 3 years before he can start earning social security, and and I was wondering why can't he retire now if he's that scared? Because he's afraid of his job and the kind of things that is happening on the job and stuff like that. That's why we all need to prepare ahead for this kind of things. Like it or not, thanks to medicine, we are all getting old. We have the opportunity to get old. Like when I give these lessons on Social Security, I say, look, people, you need to understand that when they came up with the idea, with the concept, people were dying at 40-something, 47-ish. So they came up with that concept with the hope that whether you like it or not, by 72, you should be gone. Now people are scaling 90 very easily and making 100. Making 100 is common now. It's not celebrated in Guinness Book of Records anymore. Okay, it's pretty common now. People are scaling hundreds. A 65-year-old man does not look like a haggard person about to drop dead the next minute. That's all the wonders of technology and medicine. Okay, so, but the cutoff point for Social Security has not changed. And when it gets to that point of retirement, your incomes are reduced. Anyway, and that is what all this is about, what we are preparing for. Yes, you could be 22, and you could be the grandson or daughter of Bill Clinton. Okay? For instance, somebody like that is born into wealth. I mean, if Hillary could loan herself $5 million and not blink, loan her campaign $5 million and not blink, that's not money other people can play with. Okay? So you cannot deny that they are rich and they will have provided for their children and grandchildren. So you could be 22 and be in that caliber. But at the same time, you need to be able to manage the money. We've seen, I hope we don't get people run into drug situations and similar things where they fritter away the family money. In any case, the rest of the family will run around and see what they can do to help the situation. But you could be 22 and be in that situation where you are born with a golden spoon. You could be 22 and be, just leaving college, lucky to have got all the scholarships and just getting into the workplace. You could be 22 and gotten out of college with that much heavy student loans, which we'll talk about again when we get into talking about the power of the compounding interest. So 22 is not scary. The only thing is it gives you a lot of time. It gets you into, getting into aggressive investment. It gives you the opportunity because you got to prepare for when you're 90. You may think that's 70 years away and it's such a long time of so many generations. Yes, by the time you settle down, get married, or get involved with people, have kids, and whichever path life takes you, 70 will soon show up. By the time you are 60, you know that, oh, I hope I didn't waste all these years. And that is the point of these lessons, the point of start watching these programs and doing something about it. So yes, 22 is power, but I know a young lady who's 25 and she's a senior manager in a company. To be honest with you, she's in it's a logistics business. She went to nursing school. By the time she graduated, she didn't like that profession. She didn't like to work there. So she got into the haulage thing, which she started even before she got into nursing school. So she had some experience which counted in her favor. Even while she was in the nursing school, she used to go back to do part-time. Now, as a nurse, she's back in the haulage business. While in there, because of her credentials, she's been able to get into some educational courses, management courses in and there. And it doesn't matter whether it's a nursing degree. It's a degree. She's moving on in the business, in the company. So she's a senior manager even at 25. A senior manager is not small money. She's not even married. Okay? So, but then, at the same time, that kind of money still needs some management. It still needs some management. It still needs some disciplined management. And that is the essence of this kind of discussion. Why compound interest? It's another question somebody asked me. Well, that's a wonderful question to ask somebody like me. Somebody like myself is a recent immigrant in the US. When I came in here and there is everything interest rate of 1% and 0.5%, they were like too cheap. They were like, oh, what kind of, place is this? Loans should be easy here. Because everything here is compound interest. Unlike where I'm coming from, where the simple interest is usually used to calculate things. So you may have heard me mentioning 11% interest rate in some economies and stuff like that. This is because, in some of those calculations, they actually use the simple interest, which is cheaper and easier to, to grasp. But in the compounding interest, it builds quickly. That 0.5% is added onto your principal, added onto what you get at the end of the year, added and added again. So even as we built 2 million very easily yesterday, over 50 years, from $13 a day to $2 million. So easy, so equally, you build a lot of margins when you take a loan at a compound interest rate. It just keeps on, spiraling like that. So, irrespective of where you find yourself in this scheme, whether you're taking a mortgage or you're taking student loans, I mean, many of us are aware of the problems we've had in recent time of what's going on about student loan crisis in the US, okay? Many people, take the loans, they come out of work. I mean, they come out of school, they don't even have the jobs that matches the kind of skills or the kind of education that they had. So they can't afford, they can't handle the loans. They can't afford to pay the loans. Some are struggling to pay it so that they can have some credit to buy houses or to, leave something for their kids, for their children and generations behind them. Against all odds. And all of this, and even while they are paying, interest keeps adding. Interest keeps building. So they have to fight that student loan interest while they're trying to live as well. So it's a challenge. The compound interest can work against you very badly, and it can work in your favor very strongly if you grasp it, because it's a powerful tool of compounded, expanded, exponential increase. It creates an exponential increase in whatever you are, whatever money you are handling or working with, and that's why it's easy to build interest, to build your money and double your money very easily when we talk about doubling your money, okay, with a compound interest system than in a simple interest system. It grows exponentially because of the compound interest rate with which banks work in these economies. So you need to understand the different types of economies and what interest rate they are charging. In whichever way, the banks will still take care of the challenges in the system. So I'm going to put up that chart again about how the rule of 72 works to help you determine what loans to take, what loans not to take, or how to negotiate those loans, or find your way around those loans. Because the same way it works with building your money, it works against taking your, paying off debt. Now, if you are building the money, if you are interested in building the money, you can see what kind of bank account, what kind of investment, what kind of security you should involve yourself in order to grow it. It's not just, this is the discipline of, I'm saving some money every month. You need to probably find, if you are really interested in your future, you need to find an investment advisor, somebody to advise you on how much you have, how much you're able to put together, how much you're able to put aside for yourself, for your future. For yourself, for your future. When I'm 70 or when I'm 50, I don't want to work again. As a person, that was my decision. And since I've been 50, I've not been working. I've not really been working for, like working in my profession. So it's a decision you can make, but it takes some discipline ahead of time. This is the purpose of this kind of discussions. Okay, so the little that you have right now can build right quickly, whether you are 22, whether you are 25, whether you are 50. It just depends on how aggressive and what you need and how ready you are to discipline yourself. There is another issue coming up right now. Like I mentioned, the retirement cost. We call it the retirement cost. It's a cost. I don't know why they chose to call it a cost, but the point remains. that people thought that by the time they had the Social Security, like people in the US, the Social Security, which is the government retirement package, with whatever they make, whatever the IRA they put together, IRA, savings they put together, they should be able to live comfortably in retirement. The economics of the world have changed. So in other countries that I've been to, by the time you are retiring, they have something they call a gratuity, which is a lump sum of money they give you at the end of your work period, particularly if you work for government or the military service, and then they pay you on a monthly basis, what we call pension, okay? In the US and a few other countries that I know, they actually have that pension system by the government called the Social Security payment, which they give you every month. But the point is, that Social Security that they're paying you right now is not even able to take care of your rent or your mortgage. And that is where, and like I said before, we are all getting old. People don't bump off at 72 no more. So it's not as if you retire at 70, 2 years later you're dead. Or you are 65, you are dead even before the retirement. No, people are actually making it to 90, 87, 90, 87, 90. So those 17 years in the gap, between 70 and 87, what are you going to be feeding on? What are you going to be living on? That is where people are scared now of retiring. Like it or not, if you're in the US at 70, government will start paying you your money. If you don't take it, they fine you. You pay tax for not taking the money. So you are forced to take that money. If you take it and you have too much big money, you pay back in taxes. So you are trapped. So unless you really have some wealth built up somewhere to take care of when you are sick, because an 87-year-old person, let's be honest with ourselves, you won't be cooking. If you are cooking now, you won't likely not be cooking anymore. If you are jogging around, playing golf all over the place at 60, at 87, that's not very much likely to be so anymore. You likely need an attendant, somebody around you. Most times your family are gone. They are in whatever state or other country, they found their job in and checking in on you, and you didn't go. But they won't be there to see that Domino's delivered. Okay? You need medication. You need to pay for your health care. And this is what is causing many people problems now. Okay, people find themselves in homes. They've got arthritis, they cannot, they cut off this leg or cut off that part, or they replace this, and, they can't do much by themselves anymore. It's not everybody that is 90 or 100 runs the marathon. I know a 100-year-old man ran the marathon recently, and we were all clapping for him. We are all going to get old. I'm like being prophetic, or I don't know how to say it. There is nobody dying at 47 no more. With accidents, with cancer, with everything, medicine is just doing wonders. And that is why we all need to start preparing. Think of something to do. Like I said in my last episode, saving your lunch money right now, and it doesn't mean fasting all year. It just means cutting corners here and there and putting that your first hour for yourself, the first hour of your work day for yourself. And you can prepare for that time when you don't have the energy to jump all over the place anymore and live comfortably. I've seen people do it. I've seen people, running around in hospitals and stuff like that. And they don't have to move. Yes, it was great in the days when you will retire from a company and they will give you gratuity, and a pension to go with it. If you are not working for government right now, that's a no-no. That's out. That's out. The only pension you can get is from your 401k, which you put together, which you saved by yourself. And you must be willing and ready to save that, to actually get that kind of money and have it in your account waiting for you. It takes the discipline to start with that right now. And even beyond that is what I'm saying. Beyond that, you need to actually discipline yourself and save for money for when that time comes, because it will come. It's not a question of if, it's a question of when, because it will come. So let's get ready, let's get prepared. I hope I've been able to explain the money equation a little bit. I know we're going to talk about the wealth formula, where we talk about, what's the interest rate, how does inflation rate tie into the interest rate, and how does that tie into time and all of that. I'm going to break it down all on this program for you little by little. We've just talked about interest rate, which is just one component of about 7 things that we're going to, break down. Once again, this is not some get rich quick or 6 steps to make money, or 3 steps to become wealthy, or 3 retirement things you must do to get. No, this is about understanding basic knowledge, fundamental knowledge of what you need to do, how you can do it, in practical terms, the things that, all those things they have on the websites of those banks and they teach in the business schools, okay? This is what that is about. That's what we're trying to break down here for everybody. Once again, welcome. Until the next time, see you around. I'm Noah Omoluabi.